Hey traders, this is Scott Barkley. Hey, I just finished a great new video. As you know, I put short little videos up there to help you on your journey, and this one's especially great. But my goal is to turn your pains into gains. After all, I wrote the book, The Empowered Forex Trader, Turning Pains into Gains. So I'm going to get out of here and we'll get right into the video. Hey traders, this is a two-part video, how to make money trading Forex. Part one is going to be making money in trends. Part two is making money in ranges. They are both different things. All right. So let me stop here first. The goal is not to make money. It is to learn to make pips. If you do this, the money will come. Next, you must have a goal for making money. Making money for the sake of making money is not enough of a goal to enable you to make money long term. You need to want to make money for another purpose. What are your goals? Oh, I'd like to help orphans over in Romania. That's what we do. That's a good goal. Oh, we got people in Africa that don't even water. I'd like to help them dig water wells. That's a good goal. You know, my house isn't big enough. I'd like a bigger house. That's a good goal. I'd like to take better vacations. That's a good goal. I'd like to make money for the sake of making money is a lousy goal and you won't succeed. Money is a means to an end. When most people visualize a 7, 8, or even 9-figure net worth, they aren't thinking of the money itself. The real value of money is what you can do with it. In truth, money itself is rarely the end goal. We also have an emotional attachment to money, which is why you change your broker station to count pips, not money. Casinos learned this a long time. They'll put a $100 bill in, they'll give you 5 $20 plastic chips because you have no emotional attachment to that plastic chip that says 20 on it. Being motivated by money, whether by profits or to avoid losses, is not enough of a motivation to improve your performance. You also need motivation for self-development. The desire to improve, sometimes I refer to it as the growth mindset, is what I see with traders who do improve. That's from Andrew Menaker, a very famous trading psychologist. Now, that that's settled, making money in the Forex is all about figuring the big boys or the banker's agenda. Traders who trade with indicators are relying on indicators to tell them when to get in and out. No banker would ever do that. Big boys trade price action. No indicators, only support and resistance zones, channels, and tops and bottoms. Price action, understanding price action. Price action can be seen and interpreted using charts that plot prices over time. Traders use different chart compositions to improve their ability to spot, interpret trends, breakouts, and reversals. Key takeaways. This is from Investopedia, by the way. Price action generally refers to the changes of a security's price over time. Different looks can be applied to a chart to make trends in price action more obvious for traders. And this is especially true when analyzing data covering different time periods, okay? So it's very important that you have to make it obvious to traders, okay? Technical analysis, formations, and chart patterns are derived from price action. Technical analysis tools like moving averages are also calculated from price action and projected into the future to inform trades. Though many use price action to forecast future prices, prior price action does not guarantee future results. So the Forex primarily ranges. It does not normally trend. So keep it as simple as you can. If you know only a few things that are clear in the chart, you can take advantage of that opportunity. Trends, they're only found on a 240-minute chart. Below that, they're a channel. Above that, they're a day chart, and that's for swing traders, not you. They must prove the heart line. You must have less than a 45-degree angle in the trend, and you must be exhibiting Elliott wave. They must have a target 700 to 986 pips in the trend direction. Must prove that they are using Fibonacci ratios. So here I got a chart, okay, and you can see that I have plotted the waves on here. So we'll just draw them on here. You can see this is a 1, this is a 2, this is a 3, this is a 4, This is the long 5, right? So there you go. All right, 5 waves, Elliott waves down, right? So you know you're trending. Now you won't know it up here. Up here, you'll be looking for it to range. See, you don't know it's range. But then when they break out of the range, you go, oh, 1, 2. I'm in a 3rd wave. Oh, I'm expecting a 4th wave. I'm in a 5th wave. You know right where you are if you know what this does. All right, so the heart line is proven. You have to prove the heart line or you're guessing on this outer line down here. You can see they proved the heart line, and to the pip, they turn right at the channel line or the trend line. You can see the Elliott waves, all right, and you can see the 45-degree angle. That's 10 to 4 going down on your watch. It's 8 to 2 going up on your watch. All right, now in that last slide, all you needed to know is where the Fibonacci values are, and then do a reward for risk to the target. What are the targets? Fibonacci values from the last move in the same area, Fibonacci extensions from the last swing high and low. All right, so here we go. So you can see I've got the same chart up here, and I go back and grab the past, the swing high, swing low. That gives me these Fibonacci values that go to the present, all right? And they also cover the future, all right? I got to know those. They got to prove to me they know where they are, all right? So now I've got these fibs from the past down here on the chart, all right? And now I need the Fibonacci extensions from the 1 and 2 waves. So you see the swing high of the 1 wave, swing low on the 1 wave, swing high of the 2 wave, swing low though, excuse me, swing high, swing low, swing high. All right, that gives me the target, all right? There are 2 great risk to reward trading areas, this one and this one, and you don't want to miss that last one, all right? So this is where most retail traders trade, in the junk, all right, because they need more confirmation, and their indicators are lagging. So because they're trading indicators, they lag, the market moves, and finally it moves into an area where it says, yeah, we're good to go. But now you're in the junk, where you've got multiple things to stop that currency from moving. Daggone broker, he stopped me out again. No, look where you're trading, all right? All right. Practice this on the lower time compression, since channels work the same, but are found on the 60-minute chart. You will only find maybe 5 to 6 actual trends in a year, all right? So there you go, not very many. But when you get a chance to trade them, you don't want to miss them, all right? Now, when you feel you have a handle on this structure, you can tweak it further by adding the Fibonacci sequence and adding the ATR, or the average true range, as the intraday targets. So here's the same chart, got it up here. All right, now these white lines are the Fibonacci sequence, 55, 34, 89, 144, 233, 377. All right, you got to memorize those numbers, all right? You can see these big wide open areas right here. Now intraday, there's a great opportunity. Intraday, there's a great opportunity. Intraday, there's a great opportunity, okay? What about this? That's a mess. Don't trade in there. Walk away, all right? All right, so we start at the top and just find the Fibonacci sequence to the downside. It's pretty easy to find. You need to memorize these numbers. I'll pull them up here for you. There they are. You can see they're 21, 34, 55, 89, 144, 233, 377, 610, and 987. That's typically as far as a trend will go, because you run out of Fibonacci sequence. Because the next one is 987 plus 610, which equals 1500 and something, which is too big for a trend. All right. So, all right, you can see that they know where these numbers are. See, they know where those numbers are. And down here's the last one. Why didn't we get there? Because we hit the channel beforehand. That was the target, but because we went too fast here, it was over. If this thing had gone slow, it'd probably come all the way down here, but it didn't. All right. All right, so here's the daily ATR on that last piece. The euro yen is 160 pips every day. All right, use a 14-day calculation. All right, so here's 160 pips, right there, to the pip. From that start at the 5 o'clock candle, there's the 5 o'clock candle the next day, exactly 160 pips. Down here, they went a little further. Why did they go a little further? Because they had a Fibonacci sequence slightly further down. So they went down and took that out. All right, those wide open spaces, 160 pips. 160 pips, that's trade 1, that's trade 2, day 1, day 2. Wow. We call these wide open spaces, right? And we trade if we have 55 or more pips, wide open space to the target. We press our winners without exception, so we make hundreds of pips, not 5 to 10. See real retail traders who have mastered this over here on the right. So you can see Thomas up here. He's got 167, five positions on the GJ. UJ has 48 plus 3 more, 45. EJ 81 plus 6 more positions for 222, 46, 518. And then he went to bed. All right, here's again, same trader. All right, so 1,350, finished the week with 1,350 pips. All right, sorry, total 3,813 for the week. That's not a year. That's not a month. That's not a week. That's one day. All right, or that's one set of trades, I should say. All right. So let's review. Once we anticipate a trend, right, and you can only anticipate them. It's easy to see them after the fact, but you have to anticipate them. They got to have at least 700 pips to the target. You got to have less than a 45-degree angle on the trend. You got to prove the heart line. You have to prove that they're using the Fibonacci retracements from the past, proving they're being used, and you need to use the Fibonacci extensions highlighting the targets. All right. Then we can find the intraday trade by finding the wide open space of 55 plus pips, the ATR target for today. We must always find the ATR target for today. It starts at 5 p.m. yesterday, and be sure there is 55 pips left in the move before 5 o'clock today. All right. So who left all this info in the charts? The big boys. They can't call each other up and say, hey, Bank America, this is HSBC. We're trying to take that euro yen down to XXX. That's called price fixing. So they can't do it that way. So how do they get everybody on board with their agenda? They put the clues in the charts. And these clues are in the charts every day, which means they're available to every trader on the planet. Retail traders don't use them because they're using indicators, thinking that's what's going to make them a trader. And in reality, they have set themselves up for failure. The trader who practices them in the past can trade the clues in the present. Reward for risk trades are there all the time for traders who will spend the time to practice in the past and then carry that forward to the present. For every 1 hour you trade live, the rule of thumb is you need to spend 3 hours trading in the past. So if you're in a live room for an hour today, then you need to spend 3 hours today in the past, learning how the market moves. So we'd love to have you watch us do this in real time in the live room. Just go to proacttraders.com, sign up for a 10-day test drive, and you can see traders making hundreds, if not more pips, doing what this video is about. It's free. And don't forget to like us, subscribe us, and share. And if you subscribe, you'll get notified when I put the next video up. And remember, this is part 1, trading, making money in trends. Part 2 is making money in ranges, and the market ranges every day. Hope that helps you.